Hello everyone, Steve Lentz here with Discover Options here at Option View Systems International. Welcome to this presentation of three different market timing reports for the S&P 500 for advanced options traders. This will be for Friday, February 2nd, getting ready for Monday, February 5th. Presented material is for educational purposes only. It should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. First, if you could please subscribe. That way you get notified whenever we come out with new videos. And also for those of you new, if you haven't already received the ebook, this is for free. Just fill out the information from the link there, and then we'll get this ebook to you. Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. All three reports, as I said, are for advanced options traders. The Condor Butterfly Timing Report is for those traders selling option premium in neutral fashions. Those who are more bullish in their outlook can sell puts in a bull-put spread approach. We have a report for those folks, and then also the statistically oriented directional likelihood report. All three relate to the current market condition, which is very unique given Friday's crazy action. You see a huge gap, and then the bar went way down, the market went way down and closed in the bottom 25% of its range there. And so that's what we kind of want to do is define this in three different fashions. The trend is that we are certainly above the 50-day simple moving average, the longer term trend, but in terms of price action, today is a downswing bar where the high is lower than yesterday's low. Friday's high is lower than Thursday's low, and not described here as the fact that today's or Friday's close is in the lower 25% of its range. Okay, I didn't put that there, but that's what we're talking about. Additionally, in terms of stochastics, I define this quite wide in terms of being between 20 and 80, and we're certainly below the percent D. So it's kind of a large range, and I needed to do that to simply get more incidences of this particular price action in a long-term uptrend like this. In fact, there's only like about 7 of them or so. Since January of 2000, this just hasn't happened that often, where you have a gap and then a big bar. And I did not include average true range definitions here at all. In fact, let's go ahead and look at some other incidences of this phenomena where you have a gap and then a move down where the close is in the bottom part of the bar. You can see two examples here right off the bat. And then just look at the price action that occurred thereafter. And let's go and look at a few others that occurred in the past. Here's another one. Okay. Here's another one. All right, and you can always just pause this and study these for yourself. But I think you do start finding a few commonalities here. You do have some action that's kind of congested. And here's one where it congested and then went up right away. So those are a few for your review, just to kind of get a feel for what happens after this market condition occurs. There's few enough of them, I could just post them there for your review. Let's go to the first report itself, the Condor Butterfly Timing Report. So since Jan of 2000, there's been 4,565 daily closes of the SPX. Of these, just over 65% have been favorable bars for selling options premium, where the actual subsequent 21 bar movement was less than what was being implied by the option prices, the SIBO skew adjusted VIX. Now also, since Jan of 2000, this current market condition has occurred roughly 7 times. It's not very often, but I'm going to report what it is, and that way you can kind of get a feel for what we're looking at. Now, of those 7, okay, 85.3%, or excuse me, let me think here. Yeah, 85.3% of the bars were similarly favorable for option premium selling. Look at that. I had to take a double take because it reminds me of another figure. This implies a selling edge of 20%. 20% roughly if you take 85.3 minus our benchmark of 65%, 65.1, a strong edge for selling premium in a neutral fashion. And you could see from those, 6 or 7 that I showed you, the market does congest quite a bit. So statistically, looking at the past, all right, it's more likely than usual that this condition will end up being a favorable one for market premium option selling. Very interesting. I mean, after that big down day, everyone's kind of freaking out a little bit, but yet if you go back and look at that same condition, the market does, in this condition, typically wobble around for a bit. And I thought that was very interesting because everyone's kind of freaking out a little bit, but in the past, the market has calmed down very in short order. And that's because we're in a long-term uptrend. And I think also the gap that occurred, typically gets filled in fairly short order. Is that a guarantee? Certainly not, but certainly the past, if you believe that it is an indicator of the future in terms of market psychology, I think it could be a little bit of a roadmap. So let's go to the bull put spread timing report. This is for those that like to sell option premium in the out-of-the-money puts, standard deviation away, 30 days out. How does this measure up? Well, since Jan of 2000, of those 4,565 daily closes, 83.3% were favorable for selling put premium that far out, 30 days away, where the actual SPX downside movement was less than what the option premium was implying. Okay, so roughly 83.3% of the time, you could flip a coin and you would find a bar where the subsequent downside movement was less than implied by the option prices. So, and then 16.7% of the time, the market did move down and hit that one standard deviation level. Now, also during that time, so that's our benchmark, 83.3. Now, of these 7 times that our market condition occurred, it looks like barely even one time did it go down that far and hit it. 6 out of 7 at least stayed above that level. All right, so this implies an edge of roughly 16%, and you can see the figures there. Statistically, it's more likely than usual that the current market condition will end up being a favorable one for selling out of the money put premium there. Implied volatility went up, certainly. That pushes the one standard deviation level farther away, and that's a big part of this calculation. Keep that in mind. All right, but that's the statistics as we have them. 7 isn't that, not too many to look at. Certainly no guarantees, but you should know that statistically, most of the time the market resolves itself, and I gave you the screenshots of previous occurrences for you to judge for yourself. Finally, let's go to the market likelihood report. You can see that we have those 7 occurrences. And this basically answers the question, based upon this current market condition and how often it's happened in the past, what's the market likely to do? Go up, down, or wobble around for a bit? And to answer that, we use distribution bands, price distribution bands. We'll come back to this report after I explain this. But what I do is I take, from the close, I go a standard deviation out of the money to the upside, a standard deviation down underneath the close, and here we're going out 5 days, and we just note that for this particular close, whether the market eventually in 5 days went up and hit the upper level, down and hit the lower level, or wobbled around for a bit. And for every close, we keep statistics as to what the market did. Go up, down, strike either border or strike neither border. And I do this not only for the 5-day time frame, but we go further out to 10 days and then 15 days, one standard deviation levels. And we note those that for all 4,565, we can see here that the upper 5-day band was struck almost 22% of the time, 21.9. The upper 10-day band, 16.4. The upper 15-day band, 15.6. So this is a benchmark distribution of price historically back to Jan of 2000. The lower band underneath the close, 16.3, 16.5, and 19.3. So these are the benchmark distribution levels. Now, let's go and look at what happened in terms of the last 7 times our current market condition occurred. Look at this. 5 of the 6 bands never got struck. The upper 5-day band got struck 14.3% of the time. Look at that. That's a big picture of lower market volatility. Now, I do ask, and I'm trying to account for some of this, it appears that one time that the lower 15-day, I see what happened. Okay, so if on Monday price goes above Friday's high, it's very unlikely, but in the case, whenever it has happened, it's only happened twice out of those 7. It appears that it happened once where it went above the high, and it happened twice, and one of those times it went below the lower 15-day band. In that case, okay, of those 2. Now then, but I just don't know where this 0.001. I can't account for that. I'll have to chase that down. And then one of those 2 times, it has struck the upper 5-day band when it exceeded the high. 3 times out of the 7, it exceeded the low, and you could see that at no time did it strike either of the bands. So all in all, folks, we have a picture of lower market volatility moving into the future. I know people are freaking out that it's a big downward move and it could turn into a huge bear market, and that's the fear, of course. That's why the VIX went way up. But when you go back and look at this price pattern in the context of stochastics and trend, it just is a different picture. Okay, no guarantees. Of course, everyone's kind of on pins and needles a little bit as to what Monday can bring, but at least you can go back yourself and look at those past examples, okay? Perfect. Folks, thanks for joining us. I'm Steve Lentz with Discover Options. Have a great week coming up.